Hello dear students, let us understand about capital structure in this session. Okay, see, capital structure comes under financing decision. Basically there are three kinds of decisions, right? What are all the? First one is investment decision, financing decision and dividend decision. There are three different kinds of decisions are there in finance. So this capital structure concept comes under financing decision. Again, what is financing decision? How to procure the finance. See, for starting a new business or to expand a business, existing business, so we need funds obviously. For that funds, how we are going to procure that. Okay. So this is a theoretical explanation of this capital structure. So capital structure of a company refers to the composition or makeup of its capitalization, and it includes all long-term capital resources. Obviously this is for long term, no doubt in that. So where composition or makeup, whatever the meaning is, like combination, okay, so or mix up, like how this ratio is going to work. See here, see equity, preference, debentures. You all know there are different sources of finance as we studied already. Equity shares, preference shares, debentures, bank loans, factoring. There are so many concepts like that. So how you are going to take that ratio, take that proportion for your business. Say for example, you can take equity as 60%, just an assumption I am telling here. So equity is 60% and preference as 25% and debentures as again 15%. So it depends upon one business owner. Another business owner, he may change. He can take this as 50, he can increase this or reduce that. So that mix, it changes from business people, from one to another. So how we are going to take that proportion of different sources of finance. Okay. So again, it is a combination of capitals from different sources of finance. So you need to decide what percentage I should have my equity share, what percentage I should have my preference or debentures. Okay, all 100% you cannot completely give to given to this debentures. That is high risk, right? Or even 100% you are taking only equity is also risk for you. Always you should have that composition or should have that mix, right? So see here, this is a simple example, like you are starting a company where you need around 10 crores as your capital. You are in need, okay. So you as a financial manager, now you need to decide like which will be suitable for me, which capital structure will be suitable for me. So that is why it is given here. So when it comes to capital structure, so there are different combinations like this. We are studying about combination, right? Capital structure is nothing but like how mix you are just selecting the sources. See, first one, equity shares alone. Entire 10 crores I am just completely going to dedicate for provided for this equity shares alone, procure from equity shares alone. That is your choice. Second is equity cum preference. I am also selecting equity plus preference. That is also your choice. Third is equity and debentures. You are not opting preference now. You are going for equity and debentures. And fourth is equity, preference, debentures. That is what given here in this image. So this is completely this depends on the wish of the business people. They can select, they can go for equity, preference or put together everything. Okay. Anyhow, it is not going to business should not be affected. That is the ultimate aim of business owners. Okay. So after selecting all these things, the next thing is there is a term called as optimum capital structure. Capital structure, yes, the mixture, ratio, proportion, okay, fine. What is this optimum? Perfect. We can say this is perfect or clear capital structure. How to make this perfect? See here, there is a term called as maximum EPS, means earnings per share. Earnings per share. So earnings per share means for single share you should get more earnings. Then only you can proudly say that yes, I did my business in a wonderful way, I am getting more profit. Okay. So your EPS should be higher, earnings per share should be higher. Okay. And another one is cost of capital should be minimum. Cost of capital means for procuring preference or debentures or whatever, nothing is free of cost, right? You need to issue the shares. For that you have to spend some cost, or you have to bear all some expenses, right? So all those expenses should be minimized. That is why here it is mentioned as cost of capital. Cost is nothing but your expense. To procure that capital, the cost that you are spending, that should be minimized. Okay, so EPS should be high, cost of capital should be minimum. Then only you can proudly say, yes, I have opted, perfect capital structure, that is optimum capital structure. So this is the best explanation for capital structure. So it is nothing but the combination. Remember this in your mind. Clear? Thank you all.